Welcome to Wizards Institute, the #1 community to learn smart investing and financial independence.
Great. We have a very special guest today, actually my mentor in real estate investing, Tariq Sattar. Tariq, welcome and thank you.
Thank you, San. Happy to be here.
Great. Why don't we start off with who you are, Tariq, and then maybe tell us what you do in real estate. We know you do a lot. And then I want to have a lot of questions for you in terms of how you invest and why you invest and all the secrets that you'll share with us today.
Sure. So I have been in the multifamily space now for a number of years, coming up on 5 years. And prior to that was in the single family space for some years. So I have been in real estate, exclusively focused on real estate investments for the last 7+ years. Within single family, I had grown a pretty substantial portfolio in a short amount of time. And then just because of the pace at which that was going, although I was going at a pretty rapid clip of acquiring a house every 10 days or so, it still took me, a year and a half to get to about 55 single family homes. And my goal was to have a portfolio at least of about 200 homes, and I realized at that point that it was going to take a whole lot longer to get there, and started looking at other avenues within commercial real estate. And having done a lot of analysis and reading and meetings and interviews with people, zeroed in on multifamily. And that is the space that I have been in now for a number of years. I've syndicated about 1,800 units in several different states. And the acquisitions that we have syndicated total about 120 million in acquisition value. And for those acquisitions, we have raised close to 41 million in equity for the acquisitions. In addition to those syndicated acquisitions, syndicated assets, I'm also invested as a passive investor in another 4,000 units or so. So a pretty significant portfolio over the last 5 years or so that I have accumulated, have in that period have actually transitioned totally out of the single family space, and I'm exclusively focused on multifamily.
Great. Wow. Tariq, how many years was that from the 1,800 units active and 4,000 passive multifamily space?
Right. So I'm just coming up on 5 years now.
Okay. All right. So with your continued help as my mentor, hopefully we'll get there on my side as well.
Absolutely. When I started out, it took us a good year to bring our first acquisition as a sponsor in. I have to say, though, that the market has gotten a whole lot more competitive, contrary to what you would think with COVID and the eviction moratorium and impact on collections and increase in delinquencies. But that has been more than offset by the drop in interest rates and very favorable financing that is available to investors now, and the fact that there are other commercial real estate asset classes that have capital coming out of those classes and pursuing within the multifamily space. To give you a quick example of a deal that we were pursuing in Dallas-Fort Worth market within the last couple of weeks. The initial indication that we had was a whisper price of about $24 million for the asset. Initial offer that we put in was 24.5 million, so above the minimum that they were looking for. The brokerage had a record number of offers on the asset at 36 offers, of which 24 were above the asking price. So they brought quite a large number into the best and final round, and it went to an investor that put up $1 million non-refundable, no questions asked, day one.
My goodness. My
Yes.
goodness. Wow. Wow. Yeah, I want to come back to that and talk about why this asset class has been so hot. And maybe it's even more so during COVID, right? But before that, a bit more about your background. You have a very impressive background. You went to a school called Cooper Union before NYU, which many of us know is one of the top tech schools. It's a small school, if I'm correct, but it's a very top technology school, probably no less than the MITs or the Stanfords of the world. But you also had a illustrious career in finance, right? So can you kind of tell us a bit more about that, Tariq, and then how, after doing so many years of other types of investing or advising and investing, why did you then zone in on multifamily, and particularly this type of investment? Because there's so many opportunities elsewhere. So, right, can you explain that to us?
Sure. So I, did go to an engineering school, Cooper Union. I have a master's in structural design and worked as an engineer for a total of 6 months. And very quickly saw that although I had gone through all that education, that engineering was not what I was looking to do for a long period of time.
What were you engineering?
Civil engineering.
Okay.
And I was working this was in New York, as you know, Cooper Union. I was working for New York City out of school. And after several months of working there, explored, engineering, consulting, design opportunities, but decided against going further down that path and applied to several business schools and got into New York University in their MBA school and started down that path. So coming out of the business school, I started with Deloitte and Touche in their consulting group, management consulting with a focus on strategy. And I was doing that for many, many years in the Northeast, primarily, some travel, but wanted more hands-on. There's a lot of, interviews and analytics and reports, but not a lot of execution as part of the management consulting world. So wanted more hands-on experience, and in that search landed on crisis management and restructurings as an opportunity with a small firm in New York, well, small at that time. The firm's name is Alvarez and Marcel, headquartered in New York. And when I joined the firm, I was the 30th employee of the firm. And when I left the firm many, many years later, there were more than 3,000 employees, still privately held. So as part of that restructuring and crisis management practice, we would go into companies that were in significant liquidity crisis. So we would go in and try to get our arms around, first of all, the cash position, the true cash position of the company, the free cash that was available to the company, and then looking at what the various operations, lines of operations were, which were revenue or profit generating, and which were bleeding money on a daily basis, and then trying to restructure the business to most likely a somewhat of a smaller business, but something that is more profitable on the other end. And a lot of times you would go through, sometimes you would do those restructurings out of court. Sometimes you would go through a bankruptcy court supervised restructuring, a Chapter 11, and unfortunately, sometimes you would go into a Chapter 7 liquidation. So did several of those in the US. Also, then the company expanded into Europe, and I moved to London for a number of years, and as part of that, was involved in several insolvencies in Europe. So over the years, when I was doing that work, I held a management position in a company in 26 different countries over the years. Travel was excessive, was actually 100%. So that is the reason that I decided to walk away from that. This was in late 2005 that I was still based in London, decided to walk away from the corporate world and moved back to the US and started, consulting on my own, still in the same arena in the restructuring world, but more focused on smaller companies through the same private equity or banking context that I had from the restructuring work that I had been doing. Did a lot of stock market investing, and my wife kept pushing me to explore real estate and buy at least one single family home as an investment. So she kept hammering that for a number of years, and I started reading up on it in 2012, 13 timeframe, met with people, really got serious about it in 2013 and started down the path of single family in 2014. And what I had, at that point, I did not know, I did not even think that I could explore, commercial multifamily, knowing how bigger the dollar numbers were for those kinds of assets. I was looking at single family, and my research was that I need to have at least a couple of hundred homes in the portfolio, so the law of averages truly kicks in, and the cash flow, on the longer term, there's a stable stream of cash flow on a monthly basis. So started down that path. Was, as I said earlier, was acquiring a house every 10 days. Had a third-party property management company from day one, managing the assets. I was very focused on acquisitions, overseeing the rehab. I would buy these houses with cash, and as they would go through the rehab and the property management company would bring in a tenant, I would refinance them and pull out a vast part of the equity out and keep that circle going. But just the pace was not fast enough. Decided to explore other asset classes, and I looked at a lot of commercial asset classes. Looked at hospitality, looked at retail, office space, industrial, self-storage, senior housing, student housing, and multifamily. And the three sectors that I really zeroed in on were senior living, self-storage, and multifamily. Those are the three sectors that I narrowed it down to. And then at that point, I started exploring how to go about doing it, and wanted to, just as I had done for single family, wanted to meet with people that had been doing it successfully for a number of years. And knowing that I'm most likely going to be dealing with much larger numbers and with other people's money because of syndications for the larger assets, that I could not afford to make mistakes. So wanted to then identify a mentor or a program that I could join, a group that I could be a part of, and learn as being part of that. So that is when, back in late 15, early 16, I was exploring a few different options at that point here in the Midwest, in Texas specifically, and ended up joining a group here in Dallas. Brad Sumrock is the leader, the founder of that group. And I joined that in early 16, and all the investments that I have done as a passive have primarily been with other members of that group. And a bulk of the equity that we have been able to raise for the acquisitions that we have done as lead sponsors has been from the same group of people as well.
That's great. Thank you. Thank you. That's a great story. Tariq, for somebody that is new to, again, stepping a bit higher level, somebody that's considering doing real estate or maybe even other asset classes, given your vast experience looking at different things, evaluating different asset classes, you know, from storage to senior living to others and doing single family, if you were to summarize this, you know, in a minute or two, what got you so committed and so excited to obviously doing so much in multifamily syndication? What were the key reasons?
Right. So, you know, looking at just the risk and return, when I look at hospitality industry, look at office space, look at retail, the occupancy there, you know, could be significantly impacted, especially in retail and office space, by, you know, a very small number of tenants deciding to move elsewhere. In the multifamily space, you know, it's a couple of reasons. One, the affordability gap that has been there, the housing shortage in the US that has been there and growing, that, you know, those factors. And then another very interesting thing that I found out while I was doing my research was, as a sponsor, the financing that is available to multifamily in multifamily acquisitions from Fannie and Freddie, Fannie Mae and Freddie Mac, which is non-recourse financing, was not available in any other commercial space that I was looking at. It could be, again, in residential, could be possible in development through HUD, but in the other commercial spaces that was not there. So that to me was a significant factor. And then just, you know, the fact that the affordability gap with the interest of the younger, you know, generation not wanting to buy homes and have more of a, you know, mobility capability to be mobile, you know, just those factors played into it. And the fact is that the three sectors, the three areas that I mentioned to you, you know, other than multifamily, the self-storage and senior housing, very similar, you know, characterization there as well. And I continue to have interest in both of those sectors, but ever since I have been so focused in multifamily, just have not had the time to explore those any further.
Sure, sure. Do you anticipate with the new administration and how maybe the secret's out that the next 5, 10, 15 years, this multifamily space would continue to be attractive or as attractive?
You know, the cap rates have continued to compress in the space. The pricing has continued to go up, and there have been reasons for it, reasons that, you know, you could not have foreseen, you know, some time ago. The fact is that the affordability gap continues to grow. The housing shortage continues to persist. So knowing that, and especially if you are focused on and looking at markets with a net positive migration trend, sustained net positive migration trend with employers coming into those specific markets that you might be looking at. So you put all those things together, I think this continues to be a very attractive class for the next several years. One other factor that wasn't as significant when I started down this path is the depreciation loss benefit that really came into play when the tax code changes were pushed through by the current administration a couple of years ago. And what that did was that for an investment, on average, if an investor is putting in $100,000 into a multifamily investment, you could get loss in the first year of, north of $70,000 in the very first year. And then you would continue to get additional losses every year, a much smaller number, but on an ongoing basis, as long as the asset is held in the portfolio. So that has been a significant benefit, and has also been one of the reasons that has added to the interest in this asset class.
Sure. Tariq, do you have children?
Yes, I have two daughters, college-going daughters, and a son who is in sixth grade.
Perfect. Okay, this is the most important question. So I basically am following in your footsteps, like it or not. So consulting, I did my own different types of investings. And really 2020 is the year I started to focus after essentially all the things that you just mentioned, after going through all these evaluations and whatnot, started getting into multifamily. I've done a single family for a number of years as a side hustle. So I started doing smaller multifamily with my brothers and partners in Jersey. And as you know, this year joined Sunrock, and luckily was able to close a 76 store in Florida. And together with the small ones, just about 100. So I'm at least 4 years behind in terms of experience and time, and probably 20 years behind in terms of brain power with you to get to your targets. But, having gone through the W-2, gone through different experiences. So my question is, my daughter, my oldest daughter, who's 17 now, is quite interested in financial independence and real estate. What is your recommendation for somebody young, maybe not necessarily 17, but somebody that's maybe out of school? Given what you know today, would you recommend that they follow the path that you did, gain experience, small assets in multifamily, or really dive straight into multifamily and syndication, what you're doing now?
Right. So if it was, knowing what I know today, I would dive into it right away, as long as there is a good mentor to teach you. In your instance, if you are working with her, guiding her, helping her, educating her, that is going to be the key, is to make sure that mentorship is there, and to make sure that the child has an interest in this avenue. I had taken both my daughters to attend the 2-day event that Brad puts up. Had taken both of them there, although they have some interest, but not nowhere near strong enough to really pursue that at this point. And I wouldn't want to push them down that path. In their case, my hope is that once they go through, my elder one is finishing her master's this year from Johns Hopkins, and my younger one is a junior in OU, Oklahoma University. And my hope is that once they go through their college education and they have at least a handful of years of work experience in the corporate world, and have the reality of a taste of the reality of that side, they probably are going to be more open to entertaining an avenue in the real estate investment side.
Sure. No, that's great experience. I think at 17, at least my daughter is sometimes on, sometimes off. But hopefully she's more on than off. And
right, and then, as I said, as long as there is some degree of interest, and with your background knowledge and with your own, pursuit on that path, I think it's great if she has some level of interest, if she gets started so very early on. It is just absolutely fantastic.
Yeah, I'm going to come back to that, but first, let me ask you, as a passive investment syndication, I started to do that as well this year. Most of the deals that I see promise in and outside Sunrock Group are in 8 to 9% annualized sort of dividends returns, pay monthly, pay quarterly, and then 3 to 5 years, 1.5 to 2 times the money, right? You've been doing this. You've invested passively in 4,000 doors. Are you getting these numbers?
Bottom line is, San, as I had, when I was doing the single family, that my goal was to have at least a couple of hundred doors or a couple of hundred homes. And the reason was that you got to have a large enough scale that law of averages kicks in. Whatever you assume, whatever you budget going into it is going to be wrong every single time. Some would be worse, some would be better, some would be close. There'll be surprises in every single one of them. There'll be hurdles. There'll be things that you would have no expectation, no idea of that will come and hit you. So, and that was indeed the case in the single family space. In the multifamily space, the experience is not much different. I have invested in dozens of deals as a passive investor. There are those that doubled my money in under 2 years. There are those where I barely got my equity back in 4 years.
Okay. But 4,000 doors, that's a lot of scale, Tariq. Like, on an average or on a range basis, what can, if somebody were younger and maybe has a W-2 job and want to participate in passive, given your experience, and I know time frame is different, but just curious, what would you say is a reasonable benchmark return to look for?
The thing to realize is that the market has been very strong. The cap rates continue to stay compressed or compress further. The pricing keeps going up. So we are have been in a rising tide situation for a number of years. When this tide goes out, there'll be plenty of people that are naked. There will be issues at that point, but for now, the tide continues to rise. In my experience, the across the portfolio, the averages are about what is being marketed, but that is across a pretty large portfolio, and again goes back to that the scale has to be large enough that the law of averages kicks in. Now, is that 1,000 units? Is that 2,000 units in the multifamily space? I don't know. I know in a couple of years, maybe in 2.5 years, I got up to north of 3,000. And I track these quite meticulously on returns on an individual basis, returns on a cumulative basis, monthly, quarterly, annual. Overall, the average across the portfolio is in line with the monthly cash on cash and in line with the equity multiplier across the portfolio.
Okay. So again, from a risk return basis, what you said earlier, obviously these are not liquid assets, Tariq, right? Versus a stock, for example. But the stock market generates long-term 8%, but you could lose it all. The chances of a multifamily that's 90%, 95% occupied losing it all is very slim, given the demand supply imbalance, as you said. And obviously you're making a lot more than 8% on a longer term basis if you have the right investment in the right partners and sufficient diversification. So your son or daughter each got $1 million from you down the line, and you're advising them to invest this $1 million for the long term for their kids, for retirement. How do you allocate this money? How do you advise them to allocate this money?
Right. So I would, multifamily real estate is the space to be in, for longer term real estate. It will make you very decent returns in the longer term. There, markets are cyclical, real estate is cyclical as well. But the possibility of losing it all, unless there is, significant misrepresentation and fraud kind of a scenario, the possibility of losing your equity is difficult. As I said, I've had at least a couple of instances where, I've gotten the equity, maybe a percent or two, a point or two return, but have gotten the equity back. And these were assets that were troubled. They, simply were not able to be managed well by the asset managers and by the property management company. Multitude of reasons.
Sure.
We have a couple of assets in our portfolio that we have syndicated as sponsors that have not performed near the pro forma or the potential that we had, underwritten initially. But we have sold a couple of those. There's one that we are right now looking to sell. But even in a worst case scenario, we are looking at an annualized return of close to 8 to 9%.
Sure.
So still less than what we had promised, but still pretty decent return. But again, the interest in the sector continues to stay very strong. There are, as I said earlier, multitude of reasons why that is and why we think it will continue to stay strong for some period of time, especially in the B and C sector, the workforce housing that we focus in on.
Sure. So are you all in then on this $1 million in multifamily, or would you have other, I'm just curious, what other assets are in your portfolio or you would advise your kids to hold to balance out the multifamily? Right.
So, what I have done is a bulk of my investment is in a vast majority of it is in the multifamily space, but I have invested in a couple of development projects.
Okay, also real estate, yeah.
Right, one is a senior living facility. One is actually a self-storage and RV park. One is a mobile home park.
Sure.
I'm actually right now in the process of investing in another development opportunity, which is a large development of single family homes. So I have diversified some, but still within the real estate arena.
Wow. Okay. So you're 100% real estate.
Yes.
But different types of, and it looks like it's primarily workforce related housing.
Right. Primarily multifamily workforce housing, some development, which would be, and the development ones are not in multifamily space, the ones that I've invested in. And what I have done is, I have the money that I initially put in as my seed money into the various passive or sponsored acquisitions, as several of them have gone full circle or refinanced and returned the money, I'm keeping the seed money in the system, and I'm taking part of the profits out and diversifying into some of these development opportunities as opportunities come along. Sure.
Tariq, our time is running short. The title of the book that we just published, 10 Commandments of Investing, is a result of studying nearly 100 investment wizards, right, that are super successful. And what we found was that there's these commandments or guiding principles that no matter the asset class or geography or time frame, these investors all tend to follow to make them very successful. It's almost like guiding principles from the Bible, right? Commandments. What are Tariq's top investment commandments or guiding principles? I'm just things that you will always follow or never do.
Right. So, I mean, one of the key thing is that any space that I'm going to put money into, I need to understand it.
Sure.
I need to know it. I need to understand it. I need to be as knowledgeable about it as can be before I'm going to put my money into it. Mm-hmm. I need to know the risks. I need to know the returns. I need to know, things, however slight or minor the possibility might be, what kind of adverse things could happen in that space in my investment. Then within this space, since we are relying on when I'm investing as a passive investor, I'm relying on others to manage the asset, manage the investment. That relationship on who the person is or the company is that I'm giving my hard-earned dollars to is critical. I rely very heavily on my personal interaction with the decision makers. Rely quite heavily on their track record. What have they done? How long have they been doing it? How have the other historical investments been? And then I trust but verify every single time. Does not matter who it is. I dig into it, I analyze it, and rely quite heavily on my gut feel on both about individuals and about investments. If something doesn't feel right, I'll move on. I consider these investments as just like buses. If I miss this one, there'll be another one 10 minutes behind it.
Sure.
And I need to make sure that no one else is going to care about my money as much as I personally would. And I, stick by that. A lot of times people, rely on someone else doing the diligence. Someone else may have done the diligence, may have dug into it, and I'm just gonna, reap the benefit of it. I simply will not do that. So
Sure. Yeah, that's a recurring theme of almost all the successful folks, whether they're billionaires or VCs or hedge fund guys. It's really putting the 10,000 hours, get to the independence of thought, getting conviction, and really doing the work yourself to make sure that you don't make some dumb mistakes. So that's great advice, Tariq. Fantastic. Well, I'm excited. I'm excited to be following your giant footsteps. I'm also excited to hear that after getting to 1,800 active, 4,000 passive, and having done so many other types of asset classes in real estate, Tariq, that you remain excited about this asset class, which is one that I'm trying to gain as well. Hopefully our audience also, whether they're beginners or experts, can learn from this and spend a bit more time in multifamily, because it obviously worked really well for you. So Tariq, thank you so much for your sharing. Really appreciate it.
Thank you very much.
Look forward to doing a deal with you in the next year.
Absolutely. Looking forward to it.
Thank you for joining us. Please visit Wizards Institute to access the blog summary of today's session, to learn more about other speakers, and to network with other investment wizards. Wizards Institute, the #1 community to learn smart investing and financial freedom.